The next question comes from Brian McKenna with Citizens. Your line is open.
Thanks. Good morning, everyone. So if I look at all of your public companies, that includes OWL, OBDC, OTF, all three continue to deliver pretty strong results across the board. You look at the underlying fundamentals, they remain some of the best in the industry, and even for your public BDCs, they are really the best in the industry. And then you look at direct lending, gross returns that you're reported today, it should be another strong quarter for your BDC. So, your fundamentals remain really strong, but you look at all the stocks, and they're trading at pretty meaningful discounts to peers. So what do you think is still misunderstood about your businesses within the market today? And what are you doing as a management team to change these perceptions and ultimately get these stock prices higher? And then does there come a point when, insiders start to step in and they ultimately start buying some of these stocks?
So as to what investors don't understand, it's probably hard for us to give you a comprehensive answer, but you obviously talk to a lot of investors. We can offer some theory.
The next question comes from Bill Katz with TD Cowen. Your line is open.
Okay, thank you. I wish it was a day we could ask more than one. Maybe sticking with the digital story, I was wondering if you could help us understand how quickly you might be able to absorb the most recent flagship fundraising given the size of the pipeline. And then secondarily, despite the strong macro dynamics, the fund performance has been pretty weak 2 quarters in a row. I was wondering if you could help us unpack why that's the case and would that be a hindrance to drive growth from here? Thank you.
Yeah, let's first just clear up the accounting, therefore kind of not your misunderstanding, understandable misunderstanding of the return point. So I want you to cover that first, and then I'll talk about the fund.
Sure. Thanks, Bill. This quarter, we saw some mark-to-market on swaps that we have around debt that's in place. So when we look at this, we see these are very long-term projects. When you look at the underlying performance of the data centers, they are very strong. And I'll tell you, on average, across our digital infrastructure funds, Fund 1, 2, and 3, we have IRRs in the high teens. So we're experiencing great IRRs for our investors. This is short-term noise.
The next question comes from Alex Blostein with Goldman Sachs. Your line is open.
Hey, everybody. Good morning. Thanks. Another one for you guys related to credit. And while the 3 instances that occurred a few weeks ago all seem to be related to fraud, and it sounds like there's another one this morning with HBS and kind of those headlines coming out in the last hour or so here. But I guess as you look at the credit exposures broadly across your platform and acknowledging that those 4 are not really related to you guys, and it sounds like it was all related to fraud. But how are you addressing potential fraud risks across the platform? Is there anything differently that you're starting to look at? Is there extra diligence you're starting to look at throughout the portfolios? And ultimately, will that require any incremental spend if these instances start to kind of percolate throughout the industry?
Yeah, thanks. And I think maybe we want to take a slight step back and just try to comprehensively address the overall credit theme question, and you get well phrased. So I think it's actually important to level set in one place to begin with, which is credit quality here, our peers, and at the banks for that matter, despite some tempests and teapots, is very strong. Very strong. I'm going to come back to us, but let's just start with the ecosystem in total. It's very healthy. The ecosystem, the credit ecosystem, is extremely well capitalized. It's trillions and trillions of dollars, and then you have a problem, and in this case, as you point out, a handful of problems that appear to be rooted in fraud, which is kind of the least relevant indicative issue when it comes to credit quality or systemic problems, and yet has garnered extraordinary amounts of attention. Banks do a very good job. I don't want this to be misunderstood. We're all part of a common ecosystem. We have a different approach. But take banks like Wells Fargo. They do a phenomenal job. JP Morgan, phenomenal job. These are great institutions, and we work with them all the time. And so I think we should start with, it's almost like I know you're all familiar with the Mandela effect. This is like the Mandela effect of finance, which is this just common population collective misimpression, of what's going on. And for those who don't know the Mandela effect, where there's these, people imagine that the Monopoly guy had a monocle, he didn't, or the Pikachu's tail has a black tip, it doesn't. There's just these common misunderstandings and misimaginations, and I can do a list, everyone has one. Fruit of the Loom doesn't have a cornucopia. So in any case, the point being, somehow by just talking about this enough, people have worked themselves into this imaginary world where there's some big or potential credit problem. And from where we sit, now I'm going to be a little more parochial. There's definitely not. When I now look at our book, performance remains extremely strong. We've originated over $150 billion in credit over the last decade, and we're still running at 13 basis point loss rate. And it'll be higher than that over time. That's too low. That's not the right rate. We don't suggest it is.